The pain is searing. A waterfall of red on the screen has washed away weeks, maybe months of progress. Your account balance looks like a shadow of its former self. You feel a knot in your stomach, a mix of regret and fear. And then, just when you are about to give up all hope, it happens. A sudden, sharp reversal. A powerful green bar appears, erasing a large portion of the day's losses in a matter of minutes. The price is snapping back with incredible force. A voice in your head screams, "This is it. The bottom is in. If I don't buy right now, I'm going to miss the entire recovery." Hope, a dangerous and intoxicating emotion, floods your system. You feel the urge to click the buy button with a desperate intensity, believing you've just been given a second chance. This moment is one of the most powerful and deceptive traps in the entire market. The psychology at play is profound. The human mind is not built to withstand the pressure of a rapid financial decline. The crash creates a state of near panic, a feeling of being out of control. When the price suddenly bounces, it acts as a release valve for that pressure. The relief is so immediate and so potent that it clouds judgment. We are wired to seek patterns and to find hope in moments of despair. Therefore, we project our desires onto the chart. We see a V-shaped recovery because we desperately need it to be a V-shaped recovery. We are not analyzing the market, we are negotiating with it, pleading with it to validate our hopes. This is where the uninformed participant gets separated from their capital. They are trading based on an emotional reaction, not on a logical assessment of the facts. They mistake a mechanical twitch for a sign of renewed health. What you are witnessing is not a heroic charge of new buyers filled with conviction. It is something far more technical, far more neutral. It is called the automatic rally. It is named this for a reason. It happens almost automatically as a natural consequence of the physics of the market, not because of a fundamental change in sentiment. To understand it, you must first understand the mechanics of the preceding crash. That violent downward move was fueled by panic selling. But there was another group involved, the short sellers. These are traders who bet that the price would fall. To close their profitable trades, they are forced to buy back the shares they borrowed. So, as the last of the panicked sellers throw their shares away at the bottom, the short sellers begin buying to take their profits. This creates the first flicker of demand. Simultaneously, the intense selling pressure simply exhausts itself. Imagine trying to hold a beach ball underwater. It takes constant heavy pressure to keep it submerged. The moment you lessen that pressure, even slightly, the ball shoots back towards the surface due to its natural buoyancy. The market is the same. The panic selling was the immense pressure holding it down. When that selling stops or even just slows down, the market naturally bounces. There is no new powerful force pushing it up. It is simply the removal of the old force that was pushing it down. This is the essence of an automatic rally. It is a reaction. It is an echo of the fall. The volume signature is often the most important clue. During the panic sell-off, the volume, which represents the number of shares traded, is enormous. But during the subsequent automatic rally, the volume is often noticeably lower. This tells a critical story. The price is moving up, yes, but with far less participation, far less energy than the move down. It is a hollow victory. Let's build a picture of this in your mind, without needing to see a screen. Imagine a series of tall, dark towers on a skyline, each one lower than the last, representing a severe price decline. These are long red candles showing that sellers were in complete control day after day. At the base of the final, tallest tower, you see a massive foundation being laid, representing a huge spike in volume. This is the selling climax, the moment of maximum panic where the greatest number of shares change hands. Immediately following this climactic event, you see a new, bright green tower shoot up. It's fast and impressive. It might recover a third or even half of the height of the last dark tower. But when you look at the foundation of this new green tower, the volume, you notice it's significantly smaller than the foundation of the tower that fell. The upward structure is built on a weaker base. This visual discrepancy is your first major warning. The rally looks impressive on the surface, but the engine driving it is running on fumes. The price rise is disproportionate to the energy being expended. This is a classic sign of weakness masquerading as strength. To truly internalize these concepts, the serious man must return to the source. The foundation of modern technical analysis is contained within Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds. This is the original timeless wisdom, presented in the Annotated edition by Max Davidson. The annotations provide necessary context and clarity for the modern environment, ensuring the original principles of trading as a serious business, risk management, and judging the market by its own action are preserved. The link to this book is in the description below. Understanding these foundational texts transforms you from a participant who reacts emotionally into an observer who acts logically. You begin to see the market not as a chaotic mess, but as a story of cause and effect, of effort versus result. The automatic rally is a key chapter in that story, and recognizing it is a rite of passage for any serious student of the market. So, what is the correct course of action when you identify an automatic rally? The algorithm is simple, but it requires immense discipline. The first step is to do nothing. Your job is not to trade, but to observe and define the territory. The absolute low of the panic, the point of the selling climax, becomes your initial line of support. The highest point the automatic rally reaches becomes your initial line of resistance. You have just witnessed the birth of a potential trading range. This is the battlefield where the war between buyers and sellers will be fought over the coming days or weeks. The outcome of the automatic rally itself is not the end of the war, it is merely the opening skirmish. Your goal is not to predict the winner, but to wait for one side to prove its dominance. The trigger for any potential action comes much later. After the automatic rally peaks, the market will almost invariably drift back down to test the area of the prior low. This is called the secondary test, and it is perhaps the most important event in the entire bottoming process. This is where the market asks the critical question: was that panic real? Are there any sellers left? If the price drifts down to that prior low on very light anemic volume, it is a powerful signal. It tells you that the selling pressure has evaporated. The sellers who wanted to get out already did so in the panic. The lack of volume on the decline shows a lack of interest in pushing prices lower. This successful low-volume test is the first genuine sign that a durable bottom may be forming. Only after this test can you begin to look for a low-risk entry. Buying the automatic rally is buying into a question. Waiting for the secondary test is waiting for the answer. Protecting your capital during this phase is primarily an exercise in psychological defense. The rule is simple and absolute. Do not chase a rally that emerges from a panic low. You must burn this rule into your mind. Chasing this move feels like the right thing to do because of the fear of missing out, but it is statistically one of the worst entry points you can choose. The risk is poorly defined. If you buy halfway up the rally, where does your stop loss go? Logically, it must go below the absolute low of the selling climax. This often means you are risking a large percentage of your capital on a low probability trade. It is an inefficient and dangerous bet. The professional trader is not concerned with catching the exact bottom tick. They are concerned with entering at a point where the odds have shifted significantly in their favor and where risk can be tightly controlled. The automatic rally offers neither of these things. It offers only the illusion of a missed opportunity. Let's consider the possible scenarios that can unfold after this rally. The first and most textbook scenario is the one we've discussed. The rally peaks, establishing resistance. The price then drifts down for a secondary test. It holds above the prior low on dwindling volume and then begins to turn up again. This sequence of events, Selling Climax automatic rally secondary test forms the foundation of a classic accumulation phase. This is the best case scenario for future buyers, but it requires patience. The entire process can take weeks or even months. The second and more dangerous scenario is a failed rally. The price bounces, but the rally is weak and short-lived. It fails to reach a significant height and then quickly rolls over. As it approaches the prior lows, instead of volume drying up, volume begins to increase again. The price then slices through the prior low with force. This is a catastrophic sign. It means the downtrend is not over. It was merely taking a breath. Anyone who bought into the rally is now trapped in a losing position, and their subsequent selling will add fuel to the next leg down. This demonstrates why waiting for the secondary test is so critical. It helps you avoid being caught in this devastating trap. The third scenario is the one every novice dreams of, the V-shaped recovery. In this rare instance, the automatic rally never stops. It just keeps going, breaking through the newly established resistance without a significant pullback. While this does happen occasionally, often fueled by a major unexpected news event, it is the exception, not the rule. Building a trading strategy around the rarest of outcomes is a recipe for long-term failure. The professional accepts that they might miss the first part of a V-shaped recovery. They would rather miss an opportunity than suffer a significant capital erosion. They know that even in a strong trend, the market will eventually offer a lower risk entry point, perhaps in the form of a small consolidation or a shallow pullback later on. There is no need to gamble on the initial uncertain bounce. The key takeaway is to reframe your understanding of the automatic rally. Do not see it as a signal to buy. See it as a signal to start paying very close attention. It is the market's way of giving you vital information. It tells you where the sellers finally ran out of steam, and it shows you where the first line of defense from the buyers is likely to be. It provides the upper and lower boundaries of the new area of contention. Your role shifts from that of a frantic participant to that of a patient strategist. You are observing the battlefield from a high vantage point, letting the armies clash without committing your own forces. You are waiting for a decisive turn in the battle, the successful secondary test, before you even consider joining the fight. This approach, rooted in the logic of cause and effect, effort and result, is the antidote to the emotional poison of hope and fear. It replaces gambling with a calculated professional operation. The market does not care about your hopes for a recovery. It is an impersonal mechanism driven by the cumulative actions of millions of people, all acting in their own self-interest. By understanding patterns like the automatic rally, you begin to understand the collective psychology of the crowd and the deliberate actions of the large operators. You learn to read the tape, to listen to the story the price and volume are telling you, rather than the story you wish were true. This skill is not developed overnight. It requires study, observation, and the discipline to sit on your hands when your emotions are urging you to act. But this is the path to consistency. It is the process of transforming yourself from someone who is a victim of the market's emotional traps into someone who understands them and can use them to their advantage. The market will always provide these tests. The automatic rally will appear again and again after every significant decline. The question is whether you will see it as a deceptive siren call or as the valuable piece of intelligence that it truly is. If you wish to deepen your understanding of these market structures and the psychological discipline required to navigate them, continue to follow this channel. We will continue to dissect the market's behavior, piece by piece, until its language becomes clear.